Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the September investment edition of the Wealthy Behavior Podcast, where we talk about what's going on in the markets and investment universe that you need to know right now. Loyal listeners will recall that Bob usually does these podcasts with us, but he was on sabbatical, returned today, and technically available to record, but we figured we'd let him slog through his thousands of emails and get caught up. So I'm excited to be joined once again by Michael Waldron, our Director of Portfolio Management. Michael is not a new guest to the podcast. We had a really interesting episode early on about our slog through every president's biography. And we talked about some of the investment and financial lessons we learned along the way. And Michael also has updated us at least once on asset allocation changes and our investment approach. So I'm excited to have him back. Michael, thanks for joining.
Thanks for having me on again.
So August started off with probably something people weren't really aware of could be an issue, which is the unwinding of the yen carry trade. So we haven't talked about it on the podcast because it happened, I think, right after we recorded the last one. So what is the yen carry trade and why should we care that it's unwinding?
Yeah. So, you know what was interesting about that? You mentioned that Bob had just come back from sabbatical. So on his first day of the sabbatical, that's when the unwind happened. That was August 5th. And all of a sudden markets were moving quite a bit and you had a lot of people who were worked up. And this is where the language of the carry trade kind of came into popular knowledge on that day. So here we are at the end of it, and now we get to address the carry trade. So let's just talk about first what the carry trade is, kind of some theoretical relationships that are supposed to exist that would make it so that you couldn't make money like that, how it has been operating, and then how that can go against you. The first thing is when you have two countries that have different government interest rates, and let's say that you can borrow at a slight spread to those interest rates in either place, and that's neutral. If you go to a country like Japan, where you have a lower rate to borrow, and then you convert it to dollars, and let's say today you could earn 5.5% on US dollars, you'd be making an interest rate spread. If there was no change in the relationship between the two currencies, you could convert right back to yen, pay off your loan, and you've made free interest. So you've made money off of nothing. So there exists a relationship that's interest rate parity, where what should happen is you should have the currency adjust to offset the interest rate differential. So if the US interest rate is higher, that should be a sign of a real rate in the US plus inflation expectations. The inflation expectations would be higher in the US than they would be in Japan. So you should have the dollar fall relative to the yen. And therefore, there's no carry trade, no way to make money on that. But that hasn't happened, and that hasn't happened for an extremely long time with Japan's currency. And in fact, the opposite had happened. So this goes back, people were doing the carry trade, well over 10 years ago when it was 100 yen per dollar. And over time, despite Japan having persistently lower interest rates, you actually saw the dollar strengthen relative to the yen to about 140. So not only could you get more interest in the US, you were then exchanging into more Japanese yen, and you could make a whole lot of money doing that. That trade this year kind of exploded in the upward direction. So you went from a starting value in about the 140 zone of yen to dollars all the way up to 161. So as folks were borrowing in yen, investing in dollars, earning a positive spread in interest, then they were also getting FX gains. So you got a lot of folks that then pile into that sort of trade.
FX gains being what, Michael?
Being that the dollar strengthens
The
relative to
dollar
the yen.
strengthened.
So
Okay.
instead of being able to only buy 145 yen for a dollar, you now buy 160 yen per dollar.
160. Yep.
So you got your interest, and now you've got some serious appreciation too. That then reversed in a very significant way and very quickly in the summer, and particularly at the beginning of August. So it just came back to 145, but anybody who had put that trade on when it was 165 for a dollar, now all of a sudden lost a lot of money on the exchange rate. So now, if you're doing this sort of trade, you have to take it off. And if you're taking that off, what are you doing? You're basically trading right against that.
And what triggered the reversal, I guess, of the attractiveness of the trade in early August?
Yeah, I think the thought is that the US is going to bring down interest rates, and Japan was not in the same line, in fact, potentially up. So you just saw that kind of interest differential working in opposite directions.
And so why would that lead? Not that it necessarily did, right? Because we don't know exactly why markets do what they do, but why would people think that that would lead to a market sell-off?
So I think it's just the knock-on effects, right? And you can look back, to the financial crisis, and hey, a couple of different hedge funds, that were playing in mortgage-backed securities had failed. Why would that cause anything that's more of a systematic risk? And it's basically just, is there going to be a crack that comes out of this? So you have somebody who's lost too much money on that then fails, and then a domino effect goes on. So I think it was, are you going to have any institutions that ended up on the wrong side of this trade that have losses, and then all of a sudden their failure begets another failure and it starts on its way down?
Should we take comfort in the fact that the markets basically shrugged it off after a few days and we've climbed back and regained those losses?
Yeah, I think definitely. I think the idea there is, you had a patient that all of a sudden had to go in, and was there any organ damage? And then it turns out no. So, no institutions here failed because of that. You didn't end up having a constriction of credit because a bank got caught up in some of those trades. So I think basically you had an event that, if things had gone wrong, if that had then pushed something over the edge here, you could have seen that have real impact, but it didn't. So it shrugged it off, and I think you're back to normal.
That's a sophisticated trade, Michael. Who does that? What institutions? What whose money is wrapped up in a trade like that? Would retail investors be exposed to that through any of the mutual funds or ETFs that you can see them getting into?
Not really. The carry trade and retail is usually pretty separate.
So we've seen, as I mentioned already, markets come back nicely. We're near all-time highs. I think people are encouraged by the fact that we've seen some rotation out of some of the big mega cap AI driven names. There's been broader participation into other sectors, other industries, small caps, cheaper stocks, which is all healthy. But we did something internally to tighten up a little bit our stock exposure for our clients. And my understanding is it's not an insignificant move. It's not major changes like we've done in 2016 or 2020 when we were rebalancing a lot, but we kind of indirectly reduced stock market exposure across the board. Why did we do that, and how could an individual investor kind of implement the same thing in their portfolio if they weren't working with us?
Yeah, so essentially what we ended up doing, I would classify as much tighter risk management.
Okay.
So if you think about, a taut spring where you're going to bring something back on the upside or the downside, and you think about this as a machine that we're running, we made it so that the tightness of the spring at the top end would snap back much quicker. So as stocks perform well, and they should perform better than bonds on average, you don't let that push your allocation as far out of alignment with what your target is as what you used to allow for Slack. So it's essentially a risk management mechanism. Let's talk about
So,
why.
so you're Michael, real quick though, just for our listeners, you're talking about essentially what's going to trigger you to rebalance an asset class that's up, and every manager has to have some kind of philosophy on that in terms of when they're going to bring using maybe a 65 stock 35 bond portfolio mix as an example. How if stocks are outperforming bonds, how high will you let that 65% go to before you rebalance and come back, assuming you're doing it that way and you're not just doing some kind of quarterly or annual rebalance, which we're not fans of. You are talking about, in this instance, tightening up that top band in terms of when you would trigger a rebalance outside of when a client needs money, because when clients need money or when they deposit money, we're buying and selling, and some rebalancing is happening regardless.
Yeah, exactly. So this is kind of consistent with some of the rebalancing that we've talked about before. So to simplify what is a very complicated mechanism, if you just think about it as if you had a 20% return differential between stocks and bonds, you would want to rebalance. That's close to the way that this would operate. So if you had your 65-35, or if you had your 50-50 portfolio and 50% of it produced a 20% return and the other 50% produced a 0% return, how much would you then drift? And you would hit essentially at 55, you would rebalance in that case. So when we're thinking about this, we basically took the formula that makes that happen and we pulled that in. So now all you'd need is 10% relative outperformance of one asset class from another before you would come back to neutral.
And what drove that, Michael?
Uh,
I know you mentioned risk management, but is there some concern about valuations? Is it that the other asset classes are more attractive? Is the risk return trade off not where it was before this, bull market started 2 Octobers ago? All of the above, none of the above.
Yeah, would say two things primarily. So again, you look at this year and you look at where we stand right now, end of August, beginning of September, and stocks have had an unambiguously good year, right? The S&P 500 is up 19 and change percent. So it's been a really good year for stocks. It's been a fine year for fixed income, but you're talking about a spread of well over 10%. So just when you have really good years in risk assets, when they've paid off, being a little bit more vigilant, taking some of the chips and winnings off the table and not thinking that's going to necessarily continue. I think it's just a prudent strategy, regardless of pricing. The thing that I pay attention to a little bit more is how are the two asset classes priced relative to one another. So every week I look at two different measures. The first one is essentially the current earnings, so the current earnings of companies, and compare the current earnings to what the price is of the overall S&P 500. And you can get a yield out of that. So if you said none of these companies grew at all and all you're going to do is distribute all of your earnings, so think about that as a very simplified universe, what would be my yield from our current operations? And right now that's about 3.44%. Compare that to what you would get risk-free on a government bond. And right now that's 3.9% or so. So you're actually under, you have to make up with growth of the underlying company's profits, a hurdle of 40 basis points before you provide any excess return. I would much rather see that be a slight positive spread in order to be really interested in stocks. And this moves around quite a bit. It's moved from the beginning of the year. The other thing that I do is I look at the maximum earnings, inflation adjusted, and our maximum earnings reading, inflation adjusted, is actually back from 2021. So if you take the 2021 earnings, we use the Shiller cyclically adjusted method, and you use the inflation rate since then to get what that would imply for current earnings, and you divide that by current price, you end up with about a 4% maximum real earnings yield. And when you look at that compared to what you can get on a 10-year government bond, you've got a little positive spread. Still, at maximum earnings, you're barely pulling off 15 basis points relative to fixed income. And that's a big, long, boring way of saying, I think fixed income is giving you a lot of what you can get in stocks. Stocks are priced reasonably expensively compared to fixed income right now. So be a little bit more cautious. So where markets are priced relative to one another right now, it just says be a little bit cautious. You've gotten a big return on your risky section and you haven't quite caught up in earnings yet. So let's let that happen before we get really excited about forward returns.
All right, great stuff. And in our examples so far, we've used stocks as just one kind of undifferentiated basket, and then you mentioned the S&P 500. Where do the international markets come into play in something like this? Do you calculate like a global equity earnings yield, or are international stocks that may be cheaper than the U.S. not being quote unquote rebalanced back in an environment where we've tightened our bands?
The problem is when comparing to fixed income, because all of those are going to have different government yields. So in
Yep.
order to kind of get an aggregate of that is a bit less of a sensible data point. So I think it is nice, especially as US investors, to just look at the risk and return trade-off between risky and low risk asset classes to understand where you want to be. When we think about international markets, that really is all about diversification. So can you end up building a equity portfolio that's more robust over more situations, that doesn't have any single market concentration that can really throw you off if you go through a poor period for whatever reason in one market. And yes, we think international adds to that. You can build a higher expected return, lower risk global mix compared to just a US portfolio.
And I would imagine it would depend on which market was doing the best, whether it's the US, developed international, or emerging markets in that time period, for you to identify where the rebalance back opportunities are from. So in a market like this, where the U.S. I think is still outperforming the rest of the world, it is primarily going to be reducing equity exposure and not touching the cheaper international equities.
That is totally accurate. So when you take a look at where different equity markets have moved, you pretty much have developed international markets and emerging markets both up almost spot on at 10%. And you have the US up just shy of 20% on the S&P 500 and 17 or so percent on full market. That's a nice spread for US so far this year. So when you're overweight equities as an asset class, and that's been the segment that's performed by far the best, when you're reducing the allocation, it comes from that portion. So you're selling the market that has gone up the most.
So the other thing that's been going on, Michael, and we've spent a lot of time on this podcast about it. So I want to ask you your perspective, maybe in a different way. The Fed looks like they're going to be cutting rates in September. We can get into the why, how, who, what, where, but I think most importantly, as a director of portfolio management, does that change your outlook on any of our fixed income positions? More specifically, we talk a lot about stocks, but when it comes to fixed income, what does a Fed rate cutting cycle do in your mind?
Yeah, you know, it's interesting. So a Fed rate cutting cycle being different than what we're going to see in September, and I'll explain that comment in a minute. Um, when you think about fixed income portfolio, if you do have monetary easing, that obviously is good for fixed income. It also tends to be good for equities. So when you're building a portfolio and you have both of those asset classes, the outcome of that isn't so straightforward. If we have the Fed easing monetary policy, do I want to be in companies that are probably going to get a boost in growth, or do I want to be in fixed income where lower rates are going to make it so I get a higher return? And the answer might be both. So I don't think that that's a key takeaway. I think what's really important here is when you think about monetary policy, I don't think that September, when the federal funds rate is taken down by whatever it is, a quarter of a point, half a point, I don't think that that's the key moment that monetary policy has changed. So when you think about monetary policy, there's open market operations, so going in and actually making the federal funds rate change versus messaging. And the Fed's messaging has already been expansionary. So talking about going in this direction, if you go to the start of July, you had the 10-year rate, and the 10-year rate is much more economically meaningful than the Fed funds rate, was at 4.48%. You go August 30th, 3.91. So you've come down 57 basis points. So we all talk about, oh, the federal funds rate is take down by a quarter or a half. You've already had a half point decrease on the rate that matters the most for mortgages, that really touches the economy. So to me, the Fed speak about, we're going in a direction where we're going to ease and we're going to focus on growth rather than on price stability, which we think has come into a pretty good area. I think that's already started. So to me, we've already seen the start of that this summer. I think that nothing really specific out of what the Fed does in September changes that. If anything, it's maybe folks have focused on that and it doesn't have as big of an impact as some might think. I think when you have kind of rates coming down, you have to ask why. And this gets to a lot of the commentary on soft landing versus hard landing. If rates are coming down because you fell behind and you're already seeing economic troubles, and therefore you have profits that are down, you have individuals that, in order to own risky assets, have to be compensated more because maybe their jobs are at risk and capital is more scarce. I think that's the situation where it's really good for fixed income. And then if you have an environment where you're able to lower interest rates and be accommodative to the economy, but you're not in a recession type mode, that actually is favorable to stocks. And Right now, I don't think that it's clear that this is just hey, this is a fixed income rates are coming down. That's a layup. I think it's much more ambiguous than that.
Much more ambiguous because really the only signs of weakness in the economy are some labor market woes that we've seen recently, but corporate earnings and other indicators, not all of them, but I guess the biggest thing that's of a concern is some softening in the labor market.
Yeah, I think you see a couple of yellow lights showing up. Labor market, like you mentioned. I think when you take a look at percentage of loans for houses that are greater than 100% LTV, you've seen that very, very low for quite some time as property prices have continued to increase. And you've started to see that climb too. So there are a couple of things that are blinking, maybe a little bit yellow, but we're certainly not sitting in an economy where you'd say, oh, we're seeing some serious stresses on what businesses are able to produce for profits.
So, Michael, real quick, back to the tightening of the rebalancing bands for risk management. What would cause you to recommend reversing that tightening and basically going back to the original 20% leeway?
Yeah. So I guess when you take a look at the pricing of equities relative to fixed income and you say we get a head start. So if you have a head start by half of a point or a point and you're getting the growth that you should get in revenue and profits, plus a head start for taking risk on current earnings rather than what you can get risk free, then I think you're in an environment where that asset class is set up to perform, is priced attractively in line with the long term, and you want to let that run. You don't want to necessarily, generate more gains than you need to, and you can allow that again to drift up a little bit further without saying, "I'm really worried about taking excess risk." Right now, just while you're kind of at a handicap to start where you've got to already come over the a yield that's in excess of the current earnings yield to produce a positive return. I think you just want to be a little bit more cautious and say, I've gotten a really good return so far this year, and I'm not going to get caught off sides.
Great. Okay. Well, I appreciate that outlook and overview. What else is on your mind? What's on your desk, so to speak, as we head into what is usually a busy stretch in our offices between Labor Day and the end of the year? What are you working on?
Think about things that are coming up. I know that for both clients and internally, we've got an election that's coming up this fall. And I think you can't avoid that or speaking to it to some extent. So just trying to make sure that we're really locked away in terms of how we address the election and any volatility in terms of portfolio management. So a couple of things I think that are relevant on that front. So we looked all the way back to 1926, and we said, what's the average S&P 500 return in a general election year? And that answer is 11.5%. So perfectly good. That compares to 12.4% in non-election years. So slightly under average, but right in the normal ballpark. If you look back to the same time period and you say what percentage of those years are positive years for the market, and boy, it would take a lot to not have a positive year this year. 84% of them are positive. That compares to 70% non-election years and 74% across the whole sample. So slightly more than normal are positive, and that also just fits into kind of normal tolerance. So you'd say, quite objectively, returns in election years have not been different than what you'd see on average, frequency of positive or average return. The thing that I think is important is that the economy has more to do with the presidential elections result than the presidential's election result has to do with market returns. So when we look since 1932, 9 out of 10 incumbent presidents or parties seeking re-election were successful when the economy was not in a recession within the prior 2 years. So if the economy was good, you tended to see the party that was in power get reelected. Out of the 6 that sought a reelection and a recession did occur, only 1 was successful. So a lot of times it's more on their end that they have to worry about how the economy is and how the markets are than the economy or the markets having to worry about who wins the election. So I would just say to our listeners, as we get into election season and people say, oh, there'll be increased volatility, I'm not even sure I buy into that at all. you don't typically see election results really have a big impact on stock or bond prices. And I would say if you can keep that in mind and stay long term in your thinking and portfolio construction, pay attention to pricing and what matters, that's how you want to approach it from an investment standpoint. And then, of course, on all the other uh, items where you may have strong feelings, sure, go ahead and work on that, but don't let it affect your portfolio or your investment plan.
I have a feeling we're going to be sharing that quite a few times between now and early November, and who knows when the election's ultimately decided if it's not decided that night. So good advice, and I appreciate that overview. I spent some time this Labor Day weekend in a battleground state. I wasn't like campaigning or anything. I just happened to be in a state that is, I think, a toss up. Turn the TV on, and the amount of ads they have compared to what we're facing in Massachusetts, it's insane. I mean, nobody bothers, no sane candidate bothers to spend a ton of money in a presidential election in Massachusetts, but it's a free for all, and the ads are crazy, constant. I don't know if I'd like my vote to count more if I wasn't in Massachusetts, but the trade off would be every other commercial would be some nasty attack ad. But it's going to be an interesting stretch for the next 2 months.
Yeah, definitely.
So let's get back to our original passion and the thing we talk about on the podcast first. Are you reading anything good lately, or have you read anything good lately?
I anticipated you might ask that, and I'm on like the depends how you want to take this. Maybe the most boring stretch. I got a bunch of kind of theoretical investment books that I'm working through. So right
Okay.
now I'm working on the theory and practice of investment management. It's effectively a textbook, and its primary authors are Frank Fabozzi and Harry Markowitz.
Okay.
Uh, Harry Markowitz, obviously a Nobel Prize winner and a father of a lot of kind of the mathematics that came into portfolio optimization and construction, and Fabozzi known more on the fixed income side, but professor at Yale and really a very locked down, quantitatively oriented individual. So working through that diligently.
So you've decided to unwind from, 18th and 19th century presidents with investment textbooks.
That's right. I kind of went straight from a blitz on Philbrick books that I loved to and actually the wager too, which I enjoyed a lot. So I kind of got onto some ships and some emergency situations lost at sea to being right back into investment theory.
I like The Wager too. That was a pretty good book. That was about a mutiny on the high seas. And the other one that I read along those lines, The Wide, Wide Sea, The Imperial Ambition, First Contact, and the Fateful Final Voyage of Captain Cook, which I would recommend too. I thought that was pretty good from an investment standpoint. We had Kyla Scanlon on the podcast recently. She has a tremendous book out in this economy that I continue to recommend to people. And I'm really excited for in a couple of weeks, we're going to be talking to Christine Benz from Morningstar about her new retirement planning book. So, well, Michael, if you have any that you want to recommend in the future, either on the podcast or indirectly by letting me or Bob know, please do. I love talking to you about it, and I know our listeners enjoy the book recommendations, so I appreciate that.
Yeah, definitely. Sammy, those books at sea, I think the biggest thing to take out of them is leadership concepts. Boy, managing those sort of situations, that level of stress and the number of people that need to coordinate in order to succeed and survive is really interesting. I think you can read a book like that, enjoy it for the fun of the story, and then also get a lot of leadership insights.
Yeah, no, that's a great point. And the other thing, and it has nothing to do with what you just said, but I just got it out of that book, is close to 2 million sailors were estimated to have died of scurvy before they figured out how to fix that. 2 million. And then so many phrases that people will toss around come from our sailing terms, like turning a blind eye, under the weather, limeys, cut and run. And the list goes on just from those two books. It's kind of fascinating, but you guys signed up for an investing podcast, not a sailing terms podcast. So we will leave it at that. Michael, I really appreciate you joining us, and thanks for filling in.
Thank you.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.